Hey guys, and welcome back to Equity Maximalist. First, let me confess to you guys, I lied in the title. I am not actually short Apple yet, but I am strongly considering entering this position. In this video, I thought I'd give my qualitative reasoning as to why I think this position, as of right now, might not be the worst trade in the world. As it also provides context to my outlook on the general world and US economy, I thought it would be valuable to go over this thought process with you guys. Before we start, I want to clarify that this is not financial advice. Please always do your own research. I also want to clarify that if this position does become a reality, it will be a very minority position that is acting as a hedge to my larger portfolio. The last clarification before we start this is that I do not wish for Apple to go down. I do not want it to go down. I have no ill will towards Apple or its management. I use all their products. I am what you call a thoroughbred Apple fanboy. From my outlook, financially speaking, I think this might be a correct move, at least from a qualitative side. First, let's go over the company structure of Apple very quickly. I am sure you all know what Apple is and what they do. They make hardware products like the iPhone, iPad, MacBook, and AirPods, and other hardware products. On top of that hardware, they have built an ecosystem of services like Apple Music, Apple TV, and largely the Apple App Store. They make revenue by selling you the hardware you use and profit more from the applications you use on the said hardware. Their hardware tends to be on the premium side of any market that they play in. So, higher end means high margin products are the core of the company. From a financial perspective, Apple is currently trading for $2.71 trillion, and in the trailing 12 months, they generated around $91 billion in free cash flow, or a 29.8x margin. From a PE perspective, Apple's net income for the trailing 12 months was roughly $100 billion, or roughly a current PE ratio of 27. For context, the S&P is trading at a PE of around 21 as of now. Apple, from a chart's momentum perspective, is down 7.5% from all-time highs of $182 per share. The S&P is down roughly 13% from its all-time highs. So those are the financials. Now, you may be saying while 27 PE is high, it is justified because the company that we are looking at is Apple, and Apple can grow to fill in these larger shoes. And this is where I have to disagree and say that at least in the medium-term outlook, I can't see Apple being able to fill these shoes. Growth for companies is based on year-over-year data. That means we compare financial results from the past year quarter to this year's quarter and take a pulse of the company to see how it is progressing. Depending on that growth level, we value companies at different multiples to see what they can justify in terms of future cash flow generation. Trading at a 27 PE implies a company that is growing well above the average company in the economy, as the traditional long-term average of the S&P is around 15. Now, I do want to clarify that this 15 number is a miscalibrated, as it does not account for modern-day high-margin technology companies that are currently operating in a very low average federal funds rate that backdrops the current major economies around the world. Now, going back to the year-over-year information, we have to look at companies from a year-over-year perspective to understand where they are. So let's look at Apple from Q3 2021 to Q3 2022. Last year, of Q3 2022, we were in a historically low federal funds environment. People had a lot of excess cash due to economic stimulus provisions from both the federal government in forms of cash stimulus and monetary policy. This led to a rapid increase in consumer spending that trickled into Apple's pocket, leading to the company posting a 33% year-over-year revenue increase relative to 2022 in 2021. This led to a gangbuster in value increase in Apple as a whole that returned 35% in stock value to the investor in 2021 and 82% in 2020. I do not think this lasts. A company's valuation is based on two things in my opinion: its earnings and the macroeconomic environment that earnings is contextualized to. That means is that the backdrop on fiscal and monetary policy plays a large role in what value a company has. We know that the historical large fiscal spending in 2021 is gone in terms of direct stimulus. We also know that the extremely dovish monetary policy from 2021 is also gone and is continually eroding every Fed meeting. That leaves the company earnings to maintain valuation. I believe, in fact, I strongly know that Apple drew forth a lot of its demand for its products forward in 2020 and 2021 due to the favorable stimulus and cash cost. A company with more work from home status, the environment for Apple the past 2 years is starkly different from the current outlook. Last year, Q3 earnings for Apple, iPhone sales grew 50% year over year. Mac sales grew 17% year over year. iPad sales grew 12% year over year, and wearables grew at an astounding 33% year over year. This year, we have already seen every hardware category except for iPhones go down in sales, and the iPhone grew revenue at only 3% growth. This, I think, speaks to the resolute consumer spending that is still prominent in the United States and other major parts of the world today. I do not think this lasts. I think the larger hawkish economic downturn will lead to a more continual sequential demand drop from consumers, leading to a waning in overall product demand for Apple that cannot be bailed out by what I expect to be sequentially moderate growth in the service side for Apple. Additionally, the inflationary subduedness by supply chain fixes may increase margin levels for Apple, and yet I still do not see it being able to justify the valuation that it trades at today. If Apple grows revenues these coming quarters, I think it will be marginally and at near levels to the S&P 500. Thus, it cannot justify, and in my opinion will not justify, such a rich valuation. As I said, any company can only justify its valuations based on earnings and its context to the larger economic outlook. I think the earnings for this company are going to be down. They have already come down this past quarter by 11%, but I think this is the tip of the iceberg and we need to see a value compression on the company. Based on the models that I have curated, I think the stock's fair value metric should be closer to $131 a share for the medium term. This also for me implies that the broader market is a better investment because I think there are pockets of the larger market that has been oversold and under-recovered during this period of return of bullishness. I think the market is overpricing in a stabilization of inflation, but will soon start waking up to the reality that what's saving us from hyperinflation is a larger economic slowdown, and that will have a material impact on the net income of our companies. There is still more research to be done on this position for myself, specifically on the qualitative side of verifying the price of puts on Apple and modeling in profitability metrics to my larger portfolio. So once again, please take this as a generic commentary on the qualitative side. This is not, once again, investment advice. I am not qualified to provide that. Thus, this is for educational and entertainment purposes only. Thank you guys. If you liked anything I had to say, please like and subscribe, and I'll be back with more videos soon. Thank you.